Good morning, everyone, and welcome. This is Joe Scarice, founder and host, co-founder and host of the Creative Birth Strategy podcast here every Saturday and Sunday morning. Saturday mornings 8 a.m. Eastern Standard Time and Sunday mornings 9:30 a.m. Eastern Standard Time, providing consistent education, discussion, strategy, and a little taste of networking. Let's get ourselves set up here in the next few minutes. We'll dive into another great subject this morning. We're having some little technical difficulty the last couple of days. Our website is down right now. Working on that, and maybe that had some impact on the Microsoft Outlook uh, component. We had the Zoom down late yesterday, so some interesting circumstances with social media. But we will shall prevail and keep pushing out there. We're here to always kind of give us some insight and hopefully direction on different subjects. We try to really come up with some really unique subject matter every weekend. We're now scheduled out to early September in subject matter. Um, but, again, if there's a discussion that we're missing, let's tackle it. Let's get into it. And let's try to provide that out there for our listeners and our engaged followers in our group. A couple things I'd like to just point out first before we dive into our discussion this morning. I'd like to thank our sponsors, of course. We'd like to thank Mr. Yordell Perkins. Without him, we'd really not even be in this situation. He is just an excellent social media strategist, provides insight, strategy, graphic work, um, just name it, just puts it all together for us. He's the backbone to the podcast itself. With Perkatech, call to action, set up a call with them. See what you can do with them in regards to some strategy in your social media analytics, video work. Then I'd like to thank Realty 411. That would be with Linda Pelagas. She provides a national publication and national speaking opportunities throughout the country. I've been part of quite a few of them: LA, New York, Denver, Florida, Texas, Philadelphia. She's been a part of our podcast and our room here on Clubhouse for several years now. I'd like to thank also MB Capital. MB Capital provides unsecured business lines of credit in regards to business lines for investors to kind of help them keep things moving along from a cash on cash return basis. I've been a preferred partner of MB Capital now for over 10 years, working with Eric Moss. And then I'd like to thank Lendmark Capital, where I'm a senior loan analyst, providing asset-based lending throughout the country nationwide. DSCR 1 through 25 units, fixed to rent, fixed to flip, new construction, blanket loans, advisory and strategy in the space of asset-based lending. Been in the industry now 24 years as a licensed banker, here to provide hopefully insight for you and growth in your real estate portfolio. So let's get caught up on a couple things first. Obviously, our discussion this morning, the nuances of loan to value and real estate investment and investing. I have an article that I just put out recently. You could take a look at it. It's on LinkedIn, and I shared it on all my social media buckets as well. I try to post an article to complement every discussion every weekend. So I put out at least 2 articles a week through LinkedIn, and then I kind of share it into all the other social media buckets. Also, please keep in mind we are starting a local Philadelphia mastermind for the Creative Birth Strategy podcast on Monday night, second Monday of the month, 6:30. It'll start 7 o'clock. The podcasting starts from till 8 o'clock. It'll be another setup just like this, but it'll be live and Zoom and podcast all at the same time through Clubhouse. And we'll do it for an hour just like this. And it'll be a different subject once a month, Monday evening, 7 to 8 p.m. Looking forward to that, adding that to our repertoire starting in September. So let's talk about this past week. What I've seen. I traveled through many different new markets and trying to identify new investors and what their mindset is and what they think's going on, and you know what is the common denominator to a lot of the investors that I meet. One is inventory. It's still very tough to identify opportunities, but two, yet there's now opportunities coming on to the MLS, and now they're seeing some opportunities less to wholesale, and the wholesalers are still staying very steady. This NAR lawsuit, I think, has shaken realtors a little bit in the investor space. I think it'll be interesting shakeout before the end of the year. The law that came into place in Pennsylvania mandating licensed realtors to be only allowed to wholesale will be interesting to see how that will spider out into the rest of the states throughout the country over time. And I think that's very interesting. There was no representation from a wholesaling component. It was strictly done through NAR and the state of Pennsylvania, and they mandated that. It'll be interesting to see what the repercussions and the workarounds that wholesalers come up with in regards to wholesaling real estate in the state of Pennsylvania. So, and as we know, mortgage rates are kind of playing a little ropey dope right now. They're playing around with the high sixes, low seven. Commercial rates are right now doing better on the non-QM space than the bank space. Less people are thinking to go to the bank to go get an investor loan than ever before. So right now, a lot of the SBA or mixed use piece is going to the local banks or credit unions, and a lot of that pure residential investment is pretty much sticking with the non-QM environment. So let's dive into the nuances of loan to value and real estate investing. So I put an article recently together uh, just in regards to this. Understanding loan to value in real estate investing, the financial term for lenders is to express the ratio of the loan to value of the asset purchased. It is also a key assessment factor used before approving a mortgage. The LTV ratio is also calculated by dividing the amount of the loan by the appraised value of the property, expressed as a percentage. So, from a DSCR perspective, typically single families can go up to 80%. 2 unit to 4 unit, you could traditionally go up to 75%, with 80% there as an exception based on credit criteria. And then from 5 units up to, say, 25 units, under a million, you're probably somewhere around 75% max loan to value. Now, again, all this depends on the DSCR or the debt service coverage ratio of the subject property. And also depends on the credit score of the partner or the borrower in that deal. Now, obviously, a 660 to 680 credit score, there's a different LTV allowability. 680 to 700, same thing. 700 to 720, it starts allowing you to maximize loan to value. 720 to 740, same thing. 760 to 780, and so on and so on. You maximize your loan to value. Now, keep this in mind. I know I see a lot of bad advertisement out there advertising that they're second position mortgages. And in my personal opinion, you know what opinions are like. I think it's a lot of bad advertising, a lot of falsified advertising by bad brokers, and they're just baiting and switching um, investors. Because personally, I will if I'm in first position on a loan to value up to 75%. Why would I allow a second position loan with the rest of the 25% equity in the property? That means I'm leaving nothing there, God forbid, a foreclosure or a mishap on that subject property. So I would not ever allow that knowingly. And I would call the loan if I was in first position that you try to apply a second position loan, and I would be immediately notified. And the title company should not be allowed to close on that transaction. So I really don't understand why there's a lot of bad press out there, especially on Facebook. Horrendous, horrendous marketing on second position loans. And why does an investor think they rightly deserve that when then there's nothing left for the bank to recover if they screw up? It really kind of scares me a little bit, because CLTV used to be it's more of a common trend in more of a personal home where, like, hey, you owe 60% on the value of the property. Hey, we'll give you a line of credit in second position, and the combined loan to value is under 80%. So that CLTV and the LTV is a very interesting scenario when it comes to the personal home. I really don't think it should apply and should never apply to the investment space whatsoever. Um, I think it's a struggle for a lot of investors to get their head wrapped around it. But crunching the numbers, how does a second position loan work if the first property is barely debt servicing and barely making cash flow? Why would I rightfully allow a burden debt to draw the expenses higher than the income. It wouldn't make a lot of sense. So I want to kind of like walk through this a little and just make sure people really understand LTV should always leave room in the deal. I'm seeing more clients leaving even more money in the deal, leaving 30% equity in the property and only going 70% loan to value. Why? Pricing works in your favor if the LTV is lower. Look at the opportunity of the cash on cash return always first and see if you could recover all your money within year one instead of maximizing the LTV and pressuring the rate to the property. We'll go to our moderators, of course, to get started. Good morning, Amy. Welcome. Brief overview, who you are, what you do, and thoughts to the nuances of loan to value and real estate investing. Amy, are you there? Amy going once. Cannot hear Amy. Can anybody hear me? Can everybody hear me?
Yeah, yes, we can hear you.
Oh, okay. Amy, maybe you want to come in and out? I can't hear you, Amy. We'll go to our next Rose Amongst the Thorns. Good morning, Linda. Welcome. Brief overview, who you are, what you do, and thoughts to our discussion this morning, the nuances of loan to value and real estate investing.
Good morning, Joseph. Good morning, everyone. My name is Linda Pliagas, and I've been a real estate agent for over 17 years, an investor for over 20, and I own Realty411.com, which is a news and information website for real estate investors. Now, in regards to LTV, loan to value ratios, it's very important for investors to know about this because we need to know how much money we're going to need to put down on a property. Now, usually for residential purchases, investors will need 20% down. For commercial purchases, it's usually about 30% down. Now, these guidelines are not set in stone. I remember when we were asked to come up with more of a down payment than 20%, when we were buying a property, at the beginning, they assured us, hey, you're only going to need, 20%. Then they came back and said, well, no, underwriting says you're going to have to put another 10% down. So that can happen. Be aware of that. The bottom line is banks and lenders want to see skin in the game. Now, loan to value is also used as a marker, as a metric for investors that are in the growth mode for their portfolios. Many investors wait until their properties reach that 50% LTV mark. Once they do, investors will then pull out some equity and use that money to purchase more properties. Now, this is a method that many investors that I know have used, including one of my relatives, my cousin. He used this method to scale to about 40 doors in California and about 30 doors in Texas. He acquired and grew his portfolio with leverage by understanding loan to value ratios. And lastly, when it comes to loan to value ratio, the lower your LTV, the better financing terms that you will find. So this is the information I have about loan to value ratios. It's definitely something that can help you scale your portfolio if you're in the growth mode. Once you wait until your LTV reaches a certain amount, then you can definitely use some of that equity to reinvest back into other properties. Thank you so much, Joseph. Back to you.
So, Linda, I just want to get an update from you. Good morning. How's everything going with the Grand LA Real Estate Expo? How's everything going? Realty 4-in-1. Let's get some updates from you as well on a lot of that.
Oh, sure. Thank you so much, Joseph. Everything's going well. Right now, our new publication is at the printers. We'll be mailing that out in actually next week. We'll be having it next Friday. I'm so excited. And then we are working on a couple of live in-person events. We have one event in West Los Angeles, August the 3rd. And then our staple large event, the LA Grand Expo, will be October 26th, which is a Saturday. And that's the event where we typically see 800 to 1,000 real estate investors from throughout the country. So we're really excited about it. And you can find more information about that at realty411.com. Thank you so much for asking, Joseph.
Thanks, Linda. Yeah, it's interesting. There's so many very hyper-focused events this fall that I'm so excited about. I've been asked to teach CE at several expos coming up. The three of them. One is the Maryland Board of Realtor Expo in Ocean City, Maryland. The other one is the Delaware Board of Realtor Expo, Association of Realtor Expo in Dover, Delaware, and then Triple Play, which is held in Atlantic City. I'll be teaching CE on asset-based lending fundamentals. Pretty excited about that. I've been asked to come to speak at Think Realty in Orlando, Florida. I'm trying to schedule also the LA Grand Expo coming up in the fall as well. I'm officially booked for the Ohio RIA again this year, and then also the New York City Real Estate Expo at Citi Field in Queens. So, in between all that, I'll obviously identify some regional or in local events to attend as well. But I'm very excited about this. Oh, one other one. I'm not speaking at it, but I look forward to going to it. Is the NAR Realtor Expo in Boston, Massachusetts. They expect somewhere between 13 and 15,000 realtors this year because this whole NAR settlement. It'll be very interesting to see how that all kind of shakes out at that convention in Boston. But let's jump back to loan to value and understanding where loan to value derives, right? So obviously we named this house at BRRRR, Greater BRRRR Strategies. So the BRRRR part takes into account the loan to cost when you're buying a property that's in distress and where you have allowability to buy up to a certain loan to cost and then a certain loan to cost on the construction and renovation. So typically, traditionally, lenders such as myself go up to 100% on the construction rehab, and then up to 90% depending on your experience and credit score on the purchase of the property, and that's a loan to cost. Now, if you have lesser experience, it could be anywhere between 75 and 90% loan to cost, but somewhere in that variable, they're going to allow to give you a strong percent purchase situation. Then they look at the LTV on the after repair value and they get an appraisal done. So they typically don't go higher than 70% loan to value on after repair value. We get a little more aggressive depending on how much experience you have, and maybe even go up to 75% on the after repair value, with including the thoughts of up to 90% on purchase, 100% on the construction. Now, all these numbers need to work if you decide not to flip the property and you decide to hold the property. You need to be able to refinance that property back into a loan up, if it's a single family, up to 80% loan to value. But the DSCR has to work and your credit score has to work to allow that maximized loan to value. And these features to this loan product is pretty solid. I mean, like, people get a little confused thinking it's one loan. It's actually two loans because one's a construction piece, the other's more of a stabilized loan. So you're doing it. The first piece is more of a 12-month interest only with no prepayment. The second piece is a 30-year fixed with the options of different prepayment levels and LTV levels to refinance the property and stabilize it for long term. Now, in the state of Pennsylvania and in Ohio, they have exceptions to prepayment. You're not allowed to charge a prepayment in Pennsylvania under the loan amount of $315,000. in Ohio, you're only allowed to charge a 1-year prepayment. So it's very under $95,000. But the rest of the states right now allow prepayment penalties. But that's a reflection on what your rate will look like, LTV will look like. What's the game plan with the property? What's the strategy with the property? Amy, good morning. Hopefully you're back on and able to hear us, and we hear you. Good morning. Welcome. Yeah, you're good. You're good. Brief overview, who you are, what you do, and thoughts to the discussion, the nuances of loan to value and real estate investing.
Well, another day, another great room, Joe. Yes, I'm Amy Calvado. I am the founder and CEO of Facilimax, which is a real estate technology company. I'm also the chair of the U.S. PropTech Council, PropTech being real estate technology. U.S. PropTech Council is the trade association for the real estate technology industry in the United States. And I am also a longtime real estate investor. I've been investing in real estate since 2008. What I would say about loan to value is if you break it down into pieces, understanding that value is not static. Your value changes, and it's the one piece that the real estate investor has the most sway over is the value of it. You're not going to bend a lender to your will, and they're not going to loan you more money than they think is reasonable. But you do have the ability to increase the value as much as possible. But I will also say that when you are stress testing your deal, you need to take into consideration the economic factors that might have an impact on the value of the property you're getting into. And so those are outside of your control. But if you are thinking that you're going to you're going to buy a house, you're going to capture, say, maybe 20% equity, that's an easy amount that's added to your value. But then if you do not have some other method to increase that value past 20%, that might get quickly eaten up by an interest rate increase or pricing pressure from the interest rates staying where they are. So you need to understand how you're going to drive that value. I will say when I first started in real estate way back in the day, I did not understand this concept, and I routinely lost my shirt on my first several single family homes that I bought because I was either spending too much money, making it too nice, doing whatever, and then my cost to my value did not make sense, right? Or I didn't understand what was going to drive the value for that property to get to a higher level. So you have to be really, really good at understanding the comps in your area, what the market is willing to pay for certain things, which is going to drive the value. I will also say that right now there's an article that came out talking about the next looming crisis in real estate, and that is the shortage of appraisers. And I don't know where that's going to go or what that's going to impact, but understanding that your appraisals are going to take longer. The appraisals are, because there's a lack of transactional history, those appraisals are going to be off, and that's going to affect the amount of loan you're going to get and what values you're going to get. So I hope technology can save the day there, but I have to say it. That's my half a nickel for right now. I'll probably give you another half too at some point, Joe.
Well, I appreciate that, Amy. And anything updated with the PropTech Council that we need to be aware of?
Yeah, so we are coming up to a couple of events. NAR has their Innovation Summit, which is at the last week of August in Chicago. It's always a great event, and we will be present. Well, I don't know if I will be there, but the council will have representation there. Also, we will be at Blueprint, which is in Vegas in September. And I'm also representing the United States in London at a global conference for all the prop tech associations around the world. It's actually something that we are hosting. We are inviting all of the prop tech associations, so think UN of prop tech, and we're going to have one representative from each country there. So I will be representing the United States, going there and doing that as a delegate. And then obviously New York City Real Estate Tech Week. If y'all had to pick one thing to go to, I would pick that week because CRETech is such a huge conference, and there's just a lot going on that whole week in New York. And so if you're trying to get in on the trends in tech that's affecting the real estate industry, that's always a good one to go to. I got a couple others sprinkled in, but yeah, that for this year, those are the ones I'm working on. And then we have ours. The PropTech Council has a huge event. Is our first one. It will be at South by Southwest in Austin, March 9th, and it is for this Western Hemisphere. So we're inviting real estate companies and technology companies to come to Austin on March 9th. So from Canada down to Chile. And we're inviting everybody to come to this side, this side of the world. So anyway, yeah, that's what we got, Tiffany.
So, Amy, are you gonna? Have you saw the National Property Management Association meeting down in Florida, the expo? That might be a good one for you to go to as well. That's in March of next year too.
Oh yeah, for sure. Yeah, we need exposure for sure, and going to this conference. And you understand how to use a search bar to get your QR code, or you have business cards, or those online business cards, whatever it is that you need to have, and your CRM system set up, because that's how you get the most out of conferences. It's not because you went there and didn't meet enough people. It's because you don't have the systems behind you to take advantage of it. So that's, because those conferences are gold. I mean, you're going to meet so many people that go to that thing, and I've met customers and investors and a bunch of other different people at those events, and family office conferences and all that other stuff. That's why you're not getting enough out of conferences. It's because you're not set up to do that. So. Yeah. Another half a nickel. You're going to get 3 half a nickel.
I got like 20 cents so far here, but I want to agree with you on a couple things. I think we're going to go through a mass consolidation in 2 industries within real estate that over the next couple of years, more immediate than a lot of the other parts. I really do think the appraisal and the title insurance spaces are going to get extremely consolidated from an AI perspective. Just because I think you're seeing already a lot of title companies getting gobbled up by bigger title companies. You're seeing underwriters buying title companies to get on the front line. You're also seeing a massive amount of problems in timelines in getting appraisals completed and back in a timely manner. That is the biggest delay in almost every process of every loan, whether it's a rehab, fixed to rent, or fixed to flip, or a DSCR or long-term loan. It seems like they're taking longer to process. And this is another problem. You don't have enough appraisal comps to use in some of these markets throughout the country. So, I have seen more issues coming up with after repair value right now because of the lesser amount of sold and settled properties to compare against to derive those numbers. And also, it's much easier to get a comp on the market rent than right now on the value, on the after repair value I'm seeing, because there's a lot more rental comps out there being justified. But it was interesting. I had another discussion with somebody that where are all these wholesale deals being recorded and showing those comps of sold and settled? Are they being picked up by the appraisers when they're doing their analysis is a huge question and a concern. And that's absolutely going to impact loan to value, basically on the refinance side and also on the loan to cost perspective in identifying acquisition and rehab and looking at an after repair value. So these are big concerns I see coming down the immediate road. And Amy, do you want to add anything before we go to Anna?
Yeah, the other thing too is what's happening on the tech side is there is a big concerted effort of understanding that there is a crap ton of data out there that is super fragmented, and people are working on consolidating that data to make it useful for some of these processes, right? So CoreLogic is the back office engine for every realtor in the U.S. They do about 80% of the insurance claims and 80% of the mortgage applications. It's all run on CoreLogic's engine. So they have all of this huge amounts of data, and now they are working with startups and other people to say, okay, we have all this data. How can it be useful? And then there's other data sources that are out there. Like there's another group that's a startup that's doing. They do 30% of the home inspections in the U.S. and they have this huge data set, right? So how can we? And it's the people are actually asking the questions. How can we combine our data to solve these real problems? And I think that that's super cool. Will we get there tomorrow? No, but maybe in a couple of years, and if we implement AI and you start using these data sets to actually do some cool things, then we might solve our valuation problem, right? Even though appraisers it's part art, part science, maybe we can have better valuation methods going forward. So there's that.
Yeah, I do agree with you. I think we're going to see an issue down an immediate road for appraisals. I mean, there's just not enough appraisers. It's an aged industry. The average age appraiser now, I think, is like 55. Not saying that's old, but I'm saying that's not young. It's not getting younger, and they're going to have to substitute some form of virtual look at on these properties to expedite the loans. And when you do that virtual, you don't have that personal touch. It's definitely going to impact loan to value and loan to cost when you're buying and rehabbing and holding, or buying, rehabbing, and flipping, or even if somebody's buying from a homeowner perspective, it's definitely going to have impact in sales prices. You're already seeing dropping of the of prices on listings right now throughout the country, and you're starting to see appraisals values coming down a little bit, anywhere between 8 and 12% overall throughout the country as well. Good morning, Anna. Welcome. Brief overview: who you are, what you do, and thoughts to the discussion this morning: the nuances of loan to value and real estate investing.
Good morning. It's very noisy back here. My apologies. They're even working on Sunday today. But anyhow, I'm a realtor here in Chester County, Pennsylvania. We're about 40 minutes west of Philly. This is my 12th year in real estate. And I guess from a realtor perspective, all I can say is that, having basic knowledge and understanding what is available, certainly not to the degree where you're, needing to write loan applications, but it's enough to be dangerous, enough to let clients know what their options are, enough to know who to ask and to look at things objectively. I think a part that's missing as our role in all of this in the industry is being able to assess. Right, we're always selling, and we're selling ourselves, and we're presenting, and we're going after the business. But there's very little training or understanding from a realtor perspective on how to assess the situation and know what possible options are out there.
So, Anna, are you finding? I mean, Chester County is kind of its own little nook and cranny out there in the market in the greater Philadelphia area. Are you finding the value still coming in? Are you having any kind of appraisal issues on the home buying front comparatively to the investment front? Because I'm not sure.
I've had one appraisal issue in, I hate to say it, years. Yet I'll say this, though, because we're still very much multiple offers and all that fun stuff, even if there was an appraisal shortage, we negotiated up front where the buyer is absorbing it or waiving it or whatever it may be, so that it doesn't really matter what it appraises for or whether there even is an appraisal required by the bank, because unfortunately, I say unfortunately because it feels kind of wrong, quite honestly. Yes, Chester County is the wealthiest county in Pennsylvania, and they have more wherewithal and what have you. Generally speaking, most offers are 20% down, A paper, conventional conforming, cash, or they're getting a mortgage but they're waiving the mortgage, whatever it may be. So we don't really have many of those issues.
Thank you, thank you, Anna. And yeah, I just read an interesting article about Phoenixville and how it's really come around, where it's actually doing better than Malvern numbers. I don't know if you saw that recent article on Phoenixville that came out. It's crazy. They say it's the next like Westchester borough. I mean, it is kind of the next Westchester borough without the university and all, but absolutely the values in Phoenixville, in the borough, around the borough, have definitely increased nicely. Yeah, yeah, I saw that coming over the last couple of years, and I'm like, wow, that's. And then I just saw this article about it. I'm actually seeing some big advances in some markets that were quiet for several years and now are really doing well. Like Easton, Pennsylvania is doing really well. Certain areas of Allentown are doing very well. I think Bloomsburg is doing very well. Surprising, Stroudsburg is kind of like not moving as well. Williamsport's kind of a little sluggish. They have some diminished population there. I'm going to be visiting State College this fall, sponsoring an event out there as well. Those values have always held very strong in the Penn State University environment. But I want to talk about something that I had a conversation with a client yesterday at an event that I attended, and he was like, "Oh, look at these loan to values and how I can get priced out and stuff." I'm like, "Well, listen, all you need is a sizer, and you can price your own deals out." And the guy's looking at me, he's like, "What's a sizer?" I said, and this goes to what Anna was saying. I said, people need to become more educated and understanding how a loan works, because then they can understand how to identify a better deal. So you need to coordinate with somebody that's willing to provide you a pricing sizer. It's an Excel spreadsheet, and you plug in the numbers, and you could basically see what a lender will be willing to loan on based on credit score, asset type, loan amount, renovation costs, what the after repair value is, what you think the market rent will be, what the taxes and insurance will be, the LLC, the borrower, or this. So I'm going to extend this to everybody in the room. I can provide you a sizer to understand loan to value and loan to cost, and why does it matter? So when I send out a term sheet to someone that's a client of mine, I'm completely transparent. I provide them a copy of the sizer so they could see how I derived my numbers. Now, from a construction perspective, I know there was somebody asking about new construction below. Have experience. The only difference in the new construction below have experience. The only difference in the loan structure of a newer investor is that your purchase amount, the loan to cost, but we will still provide 100% of the renovations and or repairs. Now, when it comes, and then so if you're a newer investor, 83% on the purchase price, as long as your credit score is above 660. Now, if I would say 680 would be a better credit to be at to get that type of criteria, because if you're at 660, we're probably going to go like 75, 78% on the purchase and 100% on the renovation. But if your credit's really good, like 700 and above, you're definitely going to get that 83% on the purchase if you have no experience. Now, if you have experience, even one flip, one rehab completed, one rental property completed, you can get 85%. If you got 3 or 4 done, completed in the last 4 years, now you're looking at 90% of purchase on the. Now, is there an exception to go up to 75% LTV on the after repair value? Yes, it's credit related. Here, we'll do, if you want somebody to buy the land with you, meaning like you need a lender to buy the land to build. We're going to be a little cautious because we don't know how long the permit process takes. Okay, so we're probably going to be no more than 65% loan to cost on the purchase of that land. Then you're going to have to do, going to be at 75% of the loan to cost of the construction, based on a 70% loan to value on the after repair value. Now, If you buy the land and you do all the third-party work, meaning zoning, permits, architectural design, general scope of work, the invoice, all that to make it shovel ready, most lenders will give you up to 75% of what you have into that transaction on the construction. But if I'm giving you 75% of what you have into it already, of interest on your payments. So it's almost like 100% financing on the construction if you already own the land, because I'm going to take into account of loan to value and real estate investing. You're breaking up a little bit, Justin. Can you hear me? You're better now. You're in now. Oh, all right. I'll keep still there, man. Yeah, I'm in this in one of my flip properties right now. Just about to swap out some materials. But yeah, absolutely. Everybody really said most of their gems this morning. I guess I can touch on a couple of the ones that I think are most important and most relevant to right now and to whatever you have going on. The market is probably the key to anything, like any project or any development, to know where things, just keeping those things in mind. Also have a budget, right? And the other experts that you're going to need on your team that execute. So those are the things that I think are the key elements, just to get it project coordinated correctly. Now, as far as don't try to max out with the bank, because as far as your ratio, I think it's just a couple of weeks ago shopping around for lenders, like finding out which lenders are going to be the most flexible for what you're trying to do. XYZ project, right? Who the experts in Europe give you. So I appreciate that very much. And Justin's here every weekend providing his insight and his thoughts and advisory to a lot of the subject matter we tackle. And we try to tackle some really aggressive subjects. We're not light here. We're listen, if you want to be 101, that's fine, but we're going to take it to 102 rather quickly in this room and what we're providing. Very consistent education, and it's another slice to the pie of understanding to be a better real estate professional. Okay, and LTV and LTC are probably the two most important abbreviated terms to understand: loan to value and loan to cost. You need to understand that as an investor. You need to have a calculator at all times, whether in your phone or in hand, to calculate your numbers to see if the deal makes sense. Now, the pricing sizer, whether it's fixed to rent and fixed to flip or DSCR, allows you to see what your maximized leverage will be, what your pricing will look like as you maximize or minimize your leverage. So you want to be about investment properties today. We're not talking about anything owner-occupied and nothing secondary homes. Now, the same goes for short rent to the physical property itself if you do not facilitate rents coming in from STR MTR. You need to understand what LTV you're going to be allowed at. And most lenders, I would say almost all, LTV back 5% and consider the property vacant. They have to, because they're looking at the income and expense of the property at the time of the appraisal. They can't hope you occupy the property. So they got to cut your LTV back based on that. But that also helps your pricing on your rate. If you're maxed out at 70% because the property is empty and you really wanted 80%, but your rate is 7% instead of 7.5%, that cash flow difference might make up the difference of the occupancy of the unit at that time. So you got to weigh out a lot of different cost benefits and have more detailed strategic discussions with your lender, and having a good realtor in place that knows how to identify what your rental market looks like, whether it's short-term, mid-term, or long-term. Travis, good morning and welcome. Brief overview who you are, what you do, and thoughts to our discussion this morning, the nuances of loan to value and real estate investing.
Hey, good morning, Joe and everyone. I'm Travis. I have a real estate brokerage here in the Houston market. The things that I start to think of when I hear what you're talking about funding, number one, are these loans at the private equity companies like the one you work for, that or funding, are they reselling them? Are they holding the paper? Or what are they doing? And then number two, how often are these loans getting called if somebody is going and doing a second mortgage on it, or if they're wrapping the loan and reselling it to
a title company? They can close it without requesting that. Okay, they can't clear the title insurance because they're going to have to issue a new policy, right? So once they call us and say, hey, XYZ wants to put a second position note on this, are you allowing this? I'll be like, no way. And they can't close. They shouldn't be able to be allowed to close. Okay. Now, can judgments be recorded in second position because, say, there's a default or mechanics lien or something of that nature? That's different than a physical mortgage recordance. Okay. I'm not going to allow that if I'm at 75% loan to value and let somebody put 15% on the back end and leave nothing to room for me to foreclose on. It's going to just be messy. The only person that loses is that person in second position. It's not me. They're going to lose, right? And what were the other questions? I apologize. I missed the other two.
Oh, you asked the loans that you're writing, or are you reselling them?
Well, we're a hedge fund. It's our balance sheet, so it's our money. So we monitor that through our servicing department. So yeah, we're not selling. I mean, we'll sell. Like we're servicing it out and then just reimbursing it through our fund. So yeah, no, we're not a bank per se that might sell it off to a true another lender that holds the paper. We're actually keeping the paper. We're balance sheet lenders.
So have you had anybody that has wrapped that loan and then resold it?
Well, a subject to is a little different. They're not really notifying anybody. So, like, if you're
wrapping your own loans, if you're more apt to catch that, right? So, okay, you can see that the deed's been re-recorded.
Yeah. For non-paying your current, like, why would I call the loan if you're in foreclosure? I'm going to chase that loan down because that's dead weight right now. So my thought to that is that no, they're not going to chase people down if they see that change of the like in a subject to or a wrap, because they're more focused on what's not being paid. If that makes any sense. There's always a lot of creative scenarios out there with subject twos and wraps. I don't think that's going to be the high focus. I think the higher focus is combined loan to value, where they're not going to allow second position loans on these properties that are leveraged up to 75%. Doesn't make any sense. It really doesn't make any sense.
Yeah.
It really doesn't make any sense.
Yeah.
It's not going to cash flow.
Yeah. So when you're in an affluent area, like the lady was talking about, that Chester, whatever, Pennsylvania, usually you don't have an issue with that because these people, they don't care. They're going to pay the price because they want the property.
Exactly.
They have the money to pay it. But because we do the same things here in Texas, where we can have an agreement up front with them. They appraise it out at one that just had some updates, 10 years ago, and it's been a constant problem for myself and my clients. And I don't know if anybody on the stage has any ideas on how you can rectify that and get around it so you get a good appraisal.
And any insight to that? Amy?
No, it's good. I was just on this is when you list the home and where the buyer was absorbing it, why are you even toying with the idea that you need to figure out how to bring this number up higher? It should have been negotiated at time of contract.
Thank you, Anna. I really appreciate that. Good morning, Ronnie. Welcome. Thank you for your patience. Brief overview who you are and thoughts to our discussion. Do you have a statement or question in regards to the nuances of loan to value and real estate investing? Ronnie, are you there? Ronnie going once. Ronnie going twice. So let's get a quick outro from Amy. Thoughts to our discussion on LTV, appraisals, the nuances. Where's this all going with AI?
Sure. Okay. So it's a great room. Thanks for having me. Amy Palvido, longtime real estate investor, chair of the U.S. PropTech Council, and also a PropTech founder. I would say with AI and AI is going to always be there. It's not going anywhere, and it'll be kind of sitting there. I think what we need to have happen now is that the data in real estate, which is super fragmented, needs to somehow. There's a lot of data out there, but it's not. We don't have enough appraisers. It's going to put a big wrench in our gears for a lot of real estate transactions. They're just going to slow everything down. So it'll force us to get there and to get better as an industry. Which I'm always excited about any sort of improvement. I'm all about innovation. So that's my.
So my final thoughts to understanding loan to value is you need to understand loan to cost as well. You need to understand the risk assessment. You need to understand interest rates. You need to understand the approval process. You need to understand the sizers, how to price something out based on experience, credit score, asset type, loan type, what the down payment's going to be. You're always going to have something into the deal, and how to leverage the loan to cost to loan to value, and understanding refinance pieces, and whether it's a buy to hold or a fix to flip. And understanding LTV is crucial for real estate investors. It affects loan approval processes, interest rates, overall investment strategy. Managing LTV ratios effectively can help investors maximize returns while minimizing risk. If you have a specific scenario, run it through the sizer, send it back to me so we could work it through together. It helps you better understand your property. It helps you be a better real estate professional, understanding where your exposure is on the DSCR, on the loan to value, on the loan to cost. If you're a better real estate professional, and identifying better markets for you to invest in. There's multiple factors. So I want to thank everybody for their time this morning. We'll be back here next Saturday and Sunday with other new great subjects. I want to thank our sponsors. I want to thank PerkTech with Yordell Perkins. I want to thank Realty 411 with Linda Pelagas. I want to thank MB Capital, your unsecured business line of credit program. And then I'd like to thank Lenmark Capital, where I'm a senior loan analyst providing advisory and strategy. I am the co-founder and host and co-host of this podcast. It's the only room that has its own podcast, own website. We're offering educational spreadsheets for you to better understand and pencil down. The only room that offers CE accreditation for licensed real. Dream big, work hard,